Hey, good morning, everyone. Today, we shall discuss about the basics of mutual fund. Okay, most of the long-term investor will always set aside some portion of their uh, earnings to, mutual fund as a method of saving. A mutual fund offers many advantages. It will help you multiply your money. Also, it will give you a decent return with less risk. However, the mutual fund products which has come into the market are diverse and very immense. So it becomes imperative for any investor to know something about the various types of mutual funds which are available to the investor. Now, each type of mutual fund has its own advantages and disadvantages. So, an investor should generally be aware when an investment advisor comes and tries to give various types of mutual fund option. One should be able to analyze and understand which one is best suited for the person who is investing. Ultimately, the decision to make a good investment lies with the person who is investing. Hence, I found that it is important to know what are the types of mutual fund options available to an investor. So let us discuss those types of mutual funds. Okay. Now, uh, what is a mutual fund? It is just an investment product which will let an investor invest in various asset classes like equity, debt, gold, and real estate. Now you can invest directly in equity also, directly in debt also, and in real estate also. However, mutual fund gives you one of the avenues through which you can invest in these asset classes either independently or in a mixed manner, in a combined manner. However, all mutual fund gives an investor an investment service with a fee. So, what are those fees meant for? The fee or the expense which the mutual fund industry shows to the investor as the expenses is basically meant for selection of securities and for taking operational decision and rebalancing of portfolios. So uh, these three are the main work which the mutual fund do on behalf of the investor, for which they charge a fee. How is mutual fund is regulated? It is regulated by the SEBI regulation of mutual fund 1996 and also AMFI, that is Association of Mutual Fund of India regulations for eligibility, accountability, and soundness of any mutual fund product given by any asset management company. So mutual funds are operated by the asset management company. And what does it handle? Basically, an asset management company handles launching of new mutual fund scheme, marketing of those schemes, and collection of funds from the investor and investing those funds in a scheme. Now, mutual fund are assisted by, you know, most of the mutual fund companies are assisted by banks, uh, investor service centers, which helps the investor where to invest. So these service centers also help mutual funds in efficiently marketing and distributing their products, and members of the stock exchange. Of course, brokers also offer various mutual fund products to the retail investors. And finally, the custodians. If you want to know more about the custodian, there is a different video I have already made on the various financial entities which operates in Indian financial market, and custodians are one of them. So you can go into the details of who are custodian, what are their task, and how they operate. See, asset management company creates a product, with the approval of the trustees and SEBI. Trustees means any asset management company has to be backed by certain individuals in order to you know um, offer any mutual fund product to the investor. So these people who back an asset management company are called as trustees. Trustees can be a bank or any financial institution. So, and it has to be approved by the Securities and Exchange Board of India. Now, secondly, subscriptions are invited by the investors by issuing offer document. See, offer document is done when whenever an IPO comes out. It is called as red herring prospectus. Here it is called as key information memorandum. So, what does the key information memorandum has? It has got what is the investment objective of that particular mutual fund, what will be the investment pattern, how does it going to invest, whether they are going to invest in only equity, or it is going to invest in a mix of equity and debt, or a mix of equity, debt and real estate, and what will be the strategy of the fund manager. It will be a passive strategy or it is an active strategy. So based on all this, a mutual fund product is offered to a retail investor or any investor for that matter. And finally, what will be the cost and fees for subscribing to any mutual fund product by the retail investor? Uh, See, any mutual fund is done through the new fund offer. So this new fund offer is always kept open for 15 days. After 15 days, units of the mutual fund will be allotted to the investor within 5 working days of the new fund offer closing. The activities of the investor, keeping the investor record, investment details are maintained by something called as register and transfer agent, also abbreviated as R&T. See, the fund can be purchased by investor even if a new fund offer closes, if it is an open-ended mutual fund scheme. We will find out what is an open-ended mutual fund and closed-ended mutual fund. Uh, then things will get much clearer. So let us understand the nuts and bolts of the terms related to mutual fund. Something called as investment objective. So we discussed in the previous slide that AMC offers, and it will mention in its key information memorandum what is the investment objective. See, investment objective means what is the aim of the fund, what does the fund aims to achieve, and next will be very important which asset class to invest in, whether to invest in equity, whether it is invest in debt, or a combination of the two, or any other alternate investment funds also will be included in their investment objective. And finally, types of securities to be invested in. Now, the next part is the how to calculate the units. See, each unit of the mutual fund, it is always determined by the amount which is invested by the investor. Each unit represents one share of the fund. So each unit of the mutual fund has a predetermined price. Okay. So the number of units allotted will be equal to the amount invested divided by price per unit. We will go into the details of this, how this calculation is done, for because these mutual fund NAV keeps increasing oblique decreasing depending upon the increase in the increase in the value of the portfolio or decrease in the value of the portfolio. That we will what is NAV and all we will discuss further. The best part about a mutual fund is units can also be allotted in decimals. Now coming to the net assets. See, every mutual fund is based upon an underlying. The underlying can be equity, the underlying can be debt. Suppose if we assume that any mutual fund is investing in equity, and if they select four or five, equity uh, shares, like any four or five companies, so the assets of that particular mutual fund product will be those four or five companies shares. So if the company shares appreciate, the assets of the mutual fund appreciates. If it depreciates, the mutual fund value of the mutual fund depreciates. So assets of the mutual fund is the current value of the portfolio. What I just explained now. If a portfolio of a mutual fund has five equity shares, any five you can take, and if that value, if you multiply the number of shares held by the mutual fund multiplied by the present market price on that particular day, and you add all the total value, that becomes the current value of the mutual fund portfolio. Mutual fund also may have some amount of current assets like cash and the amount which are receivables. So the current market value of the portfolio plus the current assets like cash and receivables form the total assets of a mutual fund. Then what is net asset? So net asset is whatever the expenses which have occurred will be deducted from this total asset to give the net asset. The expenses may include management fee, advertising expenses, regulatory expenses, and other miscellaneous expenses. So the net assets of any mutual fund will go up whenever an additional units are purchased by the investor, or if the value of the portfolio goes up. So in both these cases, the net assets of the mutual fund go up. So when the net assets go up, the net asset value will also go up. So what is mark to market? See, mark to market is nothing but it is the process of evaluating the value of a portfolio on a daily basis. As I have explained, today if a mutual fund has three companies held, see every day the share value of the company increases or decreases. So whatever increase or decrease which has happened on any particular day, at the end of the day, the value of the portfolio of the mutual fund also increases or decreases. So this is called as mark to market. So let us understand how this net asset value increase oblique decrease. See, let us come to column number 2. Column number 2, we have a heading called as net assets. So let us consider it as column A. Next is the units outstanding. We will call it column B. So net asset value will be what? Net assets divided by units outstanding. Whatever is the unit outstanding with the asset management company about a particular mutual fund product. Let us assume initially the total net asset of a mutual fund product is 1 lakh rupees. Okay. And the units outstanding is 10,000. So what will be the net asset value? The net asset value will be 10 rupees. Now let us assume that the value of the portfolio goes up. So let us assume the value of the portfolio goes up from 1 lakh to 1,20,000. But the number of units outstanding has remained same at 10,000. So your net asset value will be 1,20,000 divided by 10,000 to give you a net asset value of 12. So increase in portfolio value will increase the net asset value. Now the second situation is, let us assume an investor redeems 1,000 units when the net asset value on a particular day is 12 rupees. So 1,20,000 minus 12 into 1,000 is 12,000 rupees has been redeemed. So 1,20,000 minus 12,000 will be 10,08,000. 1,08,000. Okay. Now, since number of units redeemed is 1,000, the units outstanding will become 10,000 minus 1,000. That becomes 9,000. So what will be the net asset value? The amount redeemed, that is 1,20,000 minus 12,000 is 1,08,000. So 1,08,000 divided by 9,000, 12. If you see the column number 7, in the column number 2, the net asset value has not changed here. So what is the conclusion? The conclusion is whenever you redeem any units from a mutual fund portfolio, there will be no change in the net asset value because the number of units also get deducted, and at the same time the amount will also get deducted from the net assets. Hence, when an investor redeems, there will be no change in the net asset value. Now, let us take the next scenario. The value of the portfolio now falls. So, as soon as the value of the portfolio falls, what happens? Now the net asset is, you know, for example, the net asset will be uh, one lakh, and the number of units outstanding will be 9,000, isn't it? So what happens? The net asset value, when it falls, what happens? Uh, the value of the portfolio has come down, but the number of units outstanding has remained the same. So we are taking the first scenario of 1 lakh and 10,000 units. Out of 1 lakh net asset and 10,000 units, so the value of the portfolio has fallen. So the value of the portfolio, it fell from where? 1 lakh 8,000 to 1 lakh. Okay, again it came back to 1 lakh. But the number of units outstanding has remained same at 9,000 after one investor redeemed 1,000 units. Okay, so when the value of the portfolio has fallen from 1 lakh 8,000 to 1 lakh, but the number of units remained same at 9,000, then your net asset value has decreased from 12 to 11.1. So whenever there is a decrease in the value of the portfolio, the net asset value, proportionately decreases. Now let us assume at this present NAV of 11.11, investor buys 1,000 units at 11.11. Now net assets as shown has become 1,11,110, and the number of units outstanding has increased from 9,000 to 10,000. So the NAV has remained the same because proportionate to the number of net asset which has increased, proportionately the number of units has also increased. So as a result, the net asset value has not changed. Now let us understand what is open-ended scheme. See, open-ended schemes are those schemes once the initial mutual fund offer, that is new fund offer, completes, the scheme remains open. So in the mutual fund market, the investors are allowed to buy and sell their mutual fund portfolios in individual mutual fund portfolios. So it allows investors to invest additional units also and redeem units also continuously at the current net asset value. Open-ended schemes are generally for perpetuity until and unless it is redeemed completely by all the investors. Now, what are close-ended schemes? See, the close-ended scheme only exists for a fixed period as determined by the mutual fund product offered by the asset management company. A certain quantity of units are offered by the AMC to the investor only during new fund offer. Once the new fund offer completes, this mutual fund scheme will not be traded. The units will be redeemed to the investors only after the tenure of that mutual fund is over, at the time when it where the NAV is prevailing at that particular point of time. Suppose if a close-ended scheme is for 3 years, there will be no mutual fund redemption till the completion of the 3 years. So whatever the net asset value after the completion of 3 years, at that particular net asset value into multiplied by the number of units held by the investor will be given back to the investor. So these are called as close-ended schemes. So the unit capital That is, the total amount of capital collected by the mutual fund company or the asset management company does not change during the entire tenure of the fund, because they have issued 1 lakh units at an NAV at the start of the NFO. That 1 lakh units will remain the same. Hence, the unit capital will not keep changing. That is, the initial capital will not keep changing. Okay. Suppose if the investor want to exit these type of close-ended schemes, in such cases, the only other option will be they have to sell their mutual fund to some other investor who is interested in buying it. Mutual fund company per se will not redeem their close-ended schemes. Now there are something called as the interval funds. What are interval funds? Actually, it is a mixture of open-ended and close-ended funds, because it is a form of close-ended fund, but only during certain period of time. For a window of 1 day or 2 day, it becomes open-ended, where investors are allowed to sell their mutual funds, or new investors are can be onboarded. So, however, it become open-ended during a specific period, which enable investor to get to purchase or redeem their units. That window period is only for 2 days. Okay, so between two window periods of 2 days, the minimum gap should be for 15 days for retail investor. And one of the most important aspect of this interval funds are, this interval fund should mandatorily be listed on the stock exchange. Now coming to the exchange traded funds. See, exchange traded fund can be traded on National Stock Exchange and Bombay Stock Exchange all day long. Here, see, we have to understand the basic principle of the NAV is determined, it will remain the same. It is based on the portfolio held by the mutual fund. However, like other mutual fund, they will have a single unit price throughout the day. From morning 9 o'clock or evening, they will have the same price. It will change only at the end of the day. However, exchange traded fund can have multiple prices on a single day, just like your stock. See, in exchange traded fund, investors, two retail investor can trade with each other. Whereas in open-ended mutual fund, it is a transaction happening between the asset management company or the mutual fund house versus the investors. Okay. See, mutual funds are regulated by SEBI regulations of 1996, as I have mentioned earlier. See, mutual fund uh, rules which are of the SEBI, actually it governs the rules with respect to setting up of the mutual fund, what should be the structure, how should it be created, and how the portfolio should be managed. And the most important is, what are the for rules formulated by the asset management company to ensure investor protection and to give satisfactory investor services. Along with SEBI, there is RBI and AMFI are also regulators of the mutual fund. Now let us understand what are the investor service standards. It's very important for anybody who is investing in the mutual fund. See, whenever an NFO is allotted, it should be allotted within 5 days from the closing date. Okay. See, as soon as an NFO is finished, see, this NFO should be open for continuous transaction for the investors. See, that should be done within 5 business days from the date of allotment. Now, every investor would like to know his fund statement. So the account statement should be given on or before 10th day of the succeeding month, if there is any change. Otherwise, it will be given once in 6 months. So whenever an investor buys or redeems, so that should be intimated through SMS or email. So that should be done within 5 days from the date of allotment. Some of the mutual funds, pay dividends. So in such cases, dividend should be dispatched within 30 days from the day of declaration of the dividend. No, very important. See, everybody would like to know what is the NAV at least once a week, but daily NAV should be available to the investor on the AMFI site by around 2100 hours. 2100 hours means a night 9 o'clock. The portfolio of the any mutual fund, what are the changes which has happened, and all these information should be disclosed every month to the investor, uh, and it will be generally be available on the AMFI site. Now coming to the half yearly financial results. See, half yearly financial result should be provided to the investor within 1 month from the close of half year. Now let us understand various types of funds available with us. Um, the first one is the equity funds. As the name itself suggests, that this fund generally invest in equity. There are different types of equity fund. One is a passive equity fund. What does this passive mutual fund do? They just invest in the stocks available in the index. That index can be Nifty 50 or BSE, anything. So just invest in the index stocks. They do not undertake any selection of stocks for the portfolio. Just they will follow the index. That's why they are called passive funds. There will be no active change in the portfolio done by the portfolio manager. He will just follow the index stocks. Next one is the diversified equity funds. See, a diversified equity fund, they generally invest across all the sectors, segments, and sizes of the company. Okay, let us understand this. Diversified means they invest across sectors. Across sectors means they can invest in banks, they can invest in infrastructure, they can invest in auto. Okay, and across segments and size of the company means they can invest in large cap company also. They can invest in small cap company also in this individual sectors. So that is why they are called as diversified equity funds. Since the investment is diversified in various sectors and various sizes and segments of the equity market, generally this fund has lower risk and also lower return. Next is based on the market capitalization. See, market capitalization nothing but the present market price of the company into its number of equity shares outstanding. That is called as market capitalization. Market capitalization changes every day depending on the market value of the share of the company. See, there are different categorization based on the market cap. It can be large cap, mid cap, and small cap. We will not go into how much should be large, what should be the market cap for a large, mid, and small. That you can see in a separate video that which I have made for equity investments. Now, large cap generally are those stocks which are listed on the AMFI list, that is, which are number one stock to 100 stocks. So, if a company invests in any of these stocks, which is between number one to number 100 in serial in the AMFI listed market capitalization list, then it is called as a large cap fund. Here, it can be any mutual fund can be called as large cap fund if and only if 80% of the total assets should be in the large cap. Mid cap is from 101 to 250 serial in on this AMFI list. Any stocks in this list invested by a mutual fund company of a particular scheme, then that scheme will be called as a mid cap, and it should at least invest 65% of total asset in the mid cap stocks. That rest can be in the small or large caps. Small cap, mutual equity funds are those where the stocks which should be above 251 in the serials of the AMFI list. Here also, 65% of the assets should be in small cap. Now let us come to know about what are active mutual funds. Active equity funds, you know, what are its characteristics? Here, the idea is to generate higher returns than the market index. So in passive, they just follow the index return. But in active, they try to select stocks which are doing well based on their momentum, based on their various fundamental and technical analysis. So, and this actively select stocks which are generating higher return at any particular point of time, and as soon as the momentum decreases, they exit those stocks. So that is called as active equity fund investment. Hence, the active stock selection is done by the portfolio manager. Finally, we will see what is flexi cap fund. Flexi cap fund has no limits across any sector and market capitalization. They can invest anyway. They can invest 100% in small cap or mid cap or large cap. So that's why they are called as flexi cap fund. So there is no limit across any market capitalization or any sector. Now coming to another equity fund, that is large and mid cap equity fund. Here 35% of the total assets should be in large cap and 35 should be in mid cap. Rest should be in any of the capitalization for stocks. It can be whether in large cap, small cap, or anywhere else. Now, in continuation with the equity funds, there are equity funds which are where investment is made only in a particular sector. Let us take, for example, banking sector. So there can be mutual funds which invest only in banking stocks, or it can invest only in infrastructure stocks. However, the downside of equity funds investing in a particular sector or public industry is that most of the sectors like auto sector, banking sector, infra, they are all cyclical in nature. Okay, and the fund manager has a very big responsibility to identify upcycle before investing in sector specific stocks. Here, the condition should be at least 85% of the total assets should be invested in the sector which it is uh, mentioned in the key information book. Suppose if they say equity mutual fund banking, so they should invest at least 85% of the total assets in the only in the banking sector. Now, equity linked savings scheme. Equity linked savings scheme mutual funds. See, they generally provide tax benefit up to 1.5 lakhs under Section 80C. So here also 80% of the portfolio should be in equity, and one important condition here is the lock-in period is for 3 years. In any mutual ELSS mutual funds, if you invest, your you know investment will get locked in for a period of 3 years. Now let us understand what is value funds. See, generally value funds require a greater time horizon because value funds are generally, investment is made based on the value investment proposition. Hence, in value investment, it is, various parameters are checked, and if the value of a stock is considered below its intrinsic value, then the investment is made. Okay, so it is a very complex thing, value investing. We will not go into the detail. Hence, that's why it is a they need longer gestation period for any company which has been identified as a potential company. We have to give them time to flourish. That's why their value funds require longer investment horizon. Now, there are certain equity funds which basically focus on dividend yield. Dividend yield is nothing but some of the company give regular dividends. We can take the example of Vedanta Limited. We can take the example of Rural Electrification Corporation, REC, Steel Authority of India. All these companies give very good dividend. Like Vedanta, dividend yield is almost 18%. Here, an investor is assured of two things. One is he will get regular dividends from the company, and at the same time, the company's share can also go up. So there will be two types of windfall profits to the individual. The value of the company may also go up, so the share price may go up, and at the same time, the company will be giving regular dividends to the investor. Now, another equity fund is based on the investment style. See, we have to understand as soon as we say investment style, so the return of that particular mutual fund will generally depend upon the style of investment, whether it is a passive investment or it is an active investment. Passive investment have lower risk and lower return, whereas active funds will have higher risk and higher return. Certain equity funds will be a theme-based fund. Here, multiple sectors operate in a theme. Let us take the example of the infra theme. In infra theme, you can have real estate funds, shares also, cement also, bank, and many of the engineering stocks can also be included in this infra theme. So we are just giving one example of how a theme-based fund works. If you take infra theme, that infra theme fund can have cement stocks also, banking stocks also, and engineering stocks also in their portfolio. Now let us come to the next concept known as the debt funds. We discussed equity funds. Now we will discuss debt funds. See, debt funds invest in basically instruments like government bonds, corporate bonds, and money market securities. If you want to know about bond market, I have made a separate video on the bond market. You please go and have a look. A complete detailed, information regarding the bonds, various types of bonds, corporate bonds, and what are money market entities and how do they function is I have already described. The most important aspect of debt funds is they will have a predefined income stream. See, there are certain debt funds which are highly liquid, like government debt funds, which has got very low risk of default. Corporate bonds, however, give you higher interest rates and higher returns, but they will also have higher risks. In order to assess the credit risk of a bond, especially corporate bond, because mostly corporate bonds are, the government bonds are generally highly secure, whereas corporate bonds are not. So they are assessment of the risk is done through a credit rating. See, debt instrument can also see a change in their prices and net asset value depending upon the interest rate scenario in the economy. Okay, and the tenor of the bond. Larger the tenor of the bond, and whenever the tenor of the bond is very high or very large, like for 10 years or 15 years, that bond will be high, considered as risky because there will be generally an impact on the interest rate scenario in the economy based on the RBI repo rate increase or decrease. So how does the portfolio manager make choices of the debt instruments? It is basically what we have discussed in the last three, four lines, that is higher coupon rate for higher risk and higher interest rate risk for higher capital gains. If you take higher interest rate risk, then you will have more capital gains. If you take higher risk, you will have higher coupon rate. For example, if you want higher coupon rate, then you can go for corporate bonds, but corporate bonds generally have higher risk. If you take higher interest rate risk, then the capital gains will be more. Suppose if you have taken a bond in the uh, when the repo rate is very high, that is at the peak, then the price capital you will achieve more capital gains when the repo rate starts coming down or the interest rate in the market starts coming down. Now coming to the various types of debt funds. So debt funds, there are numerous types of debt funds. We will analyze each one of them and understand what are the characteristics of these debt funds. The first one is short-term debt funds, uh, hybrid funds, medium duration funds. I will explain all of them in the subsequent slides. Okay. Solution-oriented schemes, long-term debt funds, exchange-traded funds, corporate debt securities, gold and real estate mutual fund debt funds, and fund of funds. Now let us understand what are short-term debt funds. See, short-term debt funds aim is to ensure higher liquidity because it is for short term. So when you are with short-term debt funds, the liquidity in the market should be high so that you should be able to sell the funds whenever you want. And secondly, since the term will be short, we should aim at saving the principal first. So short-term debt funds basically aim in saving the principal amount and secondly ensuring high liquidity. So how does it aims to achieve capital appreciation? Capital appreciation is achieved only through the interest which are earned from the debt funds. Um, there are something called as overnight debt funds. Actually, these overnight debt funds invest in securities with maturity of only 1 day. See, these type of funds are basically meant for banks, financial institution. It is generally not meant for the retail investor. So we can take all these types of debt funds with a pinch of salt because and we are not as a retail investor going to invest in these type of bonds. But the idea is to explain all types of bonds which are available in a bond market, debt no, bond funds. Now the second one is low duration fund. See here the macular duration of the fund is between 6 to 12 months. See, macular duration is nothing but the average duration of a fund. So we will not get into the too much technical about macula. There is a calculation we have to do in order to calculate the macular duration. We will keep it aside for the time being. So generally the duration of the fund should be between 6 to 12 months. Now in the medium duration funds, um, basically invest in securities, whether it is government or corporate securities, with a duration of up to 3 to 4 years. They are medium duration funds. Money market, I have already explained. They are basically for very short term. Uh, so we are not going to go into the detail of what money market fund is. But money market fund basically invest in securities with a duration of up to 1 year. Now coming to liquid funds. Liquid funds invest in securities with a maturity of less than 91 days. So if you are, if you want to keep park your money for about 2 to 3 months, you can go in for liquid funds. It will give you, a decent interest also, and at the same time, yeah, there will be very high liquidity, and you can take your money off after 3 months. So some people, basically use these liquid funds also when they want to keep their money in a safe, but which can earn a good interest for at least for a period of 2 to 3 months. Now, medium to long term duration funds invest in securities or bonds which has a duration of 4 to 7 years. Short duration bonds uh, invest in securities with a duration of up to 1 to 3 years. So if you want to park your money for about 1 to 3 years and you don't want to risk too much of your principal amount, then start short duration funds for 1 to 3 years will be the best bet, where your principal amount will also be safe, and at the same time you can earn some interest also. Here they allocate a small percentage to long-term debt security also, in order to ensure stability in the uh, whatever the returns which you are going to get. Ultra short duration fund uh, in basically invest in, see, ultra short duration funds will be available only in money market instruments. Nowhere else it is going to be uh, available. Hence the peculiar duration of this portfolio will be generally 3 to 6 months. So if you want to park your funds for about 3 to 6 months, you can put this in ultra short duration funds. Now let us analyze what are corporate debt funds. See, corporate debt funds usually have higher risk, hence they give you higher interest rate. So you will get higher interest, but the risk will also be higher. Um, Especially in corporate bond markets, an income fund tries to manage income by buying bond at a spread to government security. What does it mean? This statement means that since corporate bonds are risky, um, they will always be the interest rate provided by the corporate bond are always higher than what is given by a government security. So the difference between the interest given by the corporate bond and the interest given by the government gilt securities is known as spread. Now, corporate bond fund invest at least 80% of its total assets in corporate debt funds. They should be rated double A plus and above. If you want to know more about how corporate and CRISIL rating of bonds are done, I have made a separate video for that. You can have a look into that. Now coming to open-ended gilt fund. See, open-ended funds, they are perpetual, and you can buy and sell whenever you want. What do you mean by gilt? Gilt funds are nothing but government, issued bonds. Here, at least 80% of the total assets in government debt securities across all types of maturities will be invested. Here, there is no restriction on the maturities. It can be for 6 months also, it can be 1 year also, 5 years, 10 years. So, open ended gilt funds invest in all types of maturities, but 80% of the investment should be in government bonds. See, here there is no risk of default, but the prices of the long duration bonds can be affected by change in interest rate. Okay, I will explain this. See, interest rate in the market interest rate is determined by the RBI repo rate. See, if the repo rate keeps going up, if the RBI keep increasing the interest rate, then the banks will have to offer higher interest rate for their fixed deposit. In case if a bond is giving an interest less than the market rate, that is what interest is given by the FD of a particular bank, then this will have an direct impact on the yield of the bond. So, if the bond is of a longer duration, like 5 to 10 years, See, in generally in 10 years, there will be, this interest rate will be generally cyclical. So after a period of 5 to 6 years, when the inflation increases, generally RBI intervenes to either increase or decrease the interest rate. So increase or decrease in interest rate will ensure taking out the liquidity from the market or injecting liquidity into the market. So uh, government bonds will have no risk of default, but if the government bond is of longer duration or longer maturities, then any changes in the interest rate made by the RBI will affect the yield of the bond. Usually pension fund invest in G6. See, usually pension funds, they invest for a period of 15 years, 20 years. So these type of long maturity, government bonds are generally taken over by insurance companies and the pension funds. Now coming to dynamic bond funds, we have discussed dynamic equity. Similarly, dynamic bond funds also will have the same characteristics. They invest in bond across all the maturities and across all the coupon rate to find a best opportunity. They are not fixated about a particular maturity or a particular interest rate of a bond. So they can invest in corporate bond also. They can invest in government bonds also, and they can invest in bonds of any maturity, ranging from 6 months to 10 years or 20 years, whatever the maturity which is available in the market. Now coming to credit risk fund, what does it mean? See, credit risk fund are those funds which invest at least 65% of its total assets in corporate debt fund rated AA and below. See, any corporate funds which are rated AA and below are high risk fund. But however, since their rating is less, they will give higher coupon rate. Hence, the risk will also increase because there is a chance of any corporate bond defaulting on its repayment of the principal to the investor. Hence, it is called as credit risk fund. As medium to long term duration fund, I have already explained, it will come with a duration of up to 4 to 7 years. Similar to GSEC, corporate debt funds will also have you know maturities up to 4 to 7 years. Hence, even in corporate debt funds, medium to long term duration means 4 to 7 years. Now gilt fund means government securities. Okay. See, gilt fund basically invest in government securities with a duration of about 10 years. Now, coming to the fixed maturity funds. Um, this is a close-ended fund, fixed maturity, and the debt securities has same maturity as the term of the scheme. See, whatever the the debt bonds are the corporate bonds or non-corporate bonds which they are going to select will have the same maturity as the mutual fund maturity. So, since it will be a close-ended fund, you cannot take out the money till the time the fund term is finished. However, you can trade it in the market. Fixed maturity plan eliminate interest rate and credit risk if the fund is held passive till maturity. So, what does it mean? All these fixed maturity plan which are close ended, if you hold it till maturity, there will not be any credit risk or there will not be any interest rate risk. See, fixed maturity plan are usually preferred investment in the rising interest rate scenario. So whenever an interest rate is rising, fixed maturity plan will be preferred by the investors. Coming to banking and PSU fund. Here, this banking and PSU fund have, that fund should invest at least 80% of its total assets in the debt instruments of the bank, NBFC, and PSU. Okay, since it is a debt fund, banks are considered as corporates, NBFC are considered as corporates, and public sector units are also considered as corporates. Hence, Any bank and PSU fund will have 80% of its total assets invested in the debt instruments of these banks and financial institutions. Now coming to hybrid funds. See, hybrid fund means what? It invests in a combination of debt and securities. The allocation to these asset classes depends upon the risk and return desired. See, debt is a safe instrument, whereas securities are generally, vary a lot. Hence, depending upon the risk and return, the allocation to debt and securities will be accordingly changed. So let us see what are the different types of hybrid funds. Conservative hybrid funds invest more percentage of its total assets in debt than in the equity. Here, 75 to 90% is invested in debt. Only 10 to 25% in equity and equity related funds. The basic idea of a conservative hybrid fund is to pay more focus on generating regular income, and at the same time, since they will be investing 10 to 25% in equity, they will also have an opportunity to get some capital gains. See, the credit and interest rate risk in conservative hybrid funds are taken care by investing in liquid, high rated, short term debt securities. I have already discussed what are liquid securities, what are high rated securities, and what are short term debt securities. This fund is generally useful for conservative investor with a limited risk appetite. Now come balanced advantage fund. See, balanced means they will keep the investment in debt and security almost equal. So advantage means this fund will take advantage of any appreciation in the portfolio of the equity. Hence, they dynamically manage investment in debt and equity also. Now, balanced hybrid fund will have 40 to 60% in debt and again 40 to 60% in equity. Now, multi-asset allocation. So, multi-asset allocation will have, there will be three asset classes, and the total asset will have at least 10% investment in each of these asset classes. So, that's why they are called as multi-asset allocation funds. Now, this is, arbitrage funds are a little risky funds. So, you have to be careful while investing in arbitrage funds. What does the arbitrage funds do? You see, it takes advantage of the price differential between cash and derivatives market in each asset class. That is, it can be an equity asset class or it can be a debt asset class. So, in each of these asset class, if in the market, that is, on the stock exchange, if there is a price differential between the cash market and the derivative market, they take advantage of it. What they do is the fund will buy in spot, that is cash market is also called as spot market, and they sell the derivatives to earn the interest rate differential of the between them. See, the price differential between spot and future is locked if the positions are held till maturity. What does it mean? You buy a stock in spot and or a debt fund in spot, and you buy it in future also. See, when you are buying it, the spot and the future at some point of time has to converge, as per the theory. So when they converge, the spot and future, then it will be, you have to hold it till maturity. So when you hold it till maturity, the difference between spot and future percentage will be locked in your fund. Here, a minimum of 6 to 65% of asset is allocated to equity and equity related instruments. Now let us come to the aggressive hybrid fund. Aggressive means you have to invest in equity. Okay. So it comes with an equity oriented fund with an equity exposure between 65 to 80%. Only 20 to 30% is invested in highly liquid short term debt funds. In continuation of the debt funds, we have solution oriented scheme Like some of them want retirement funds will be there. They want the money after retirement. So this will this will have a lock-in period of about 5 years or till retirement of the individual investor, whichever is earlier. Similarly, you have something called as a children fund. So it will have a lock-in period of 5 years or till the age of maturity of the child. Now coming to close-ended hybrid funds. See here, close-end means you will have a definite time period for these funds. Uh, and hybrid fund means there will be an investment in equity and debt. So it is also called as capital protection funds because they ensure that your capital is always protected. What they are going to do to protect your capital is they are going to expose to the equity through the equity derivative markets like futures and options. They do not invest directly in the stock. They will invest in the futures or the options of the particular stock or the debt instrument. A portion of principal amount is invested in debt instruments over the term of the funds. So whatever the principal amount is there, a portion of it is invested in the debt instrument. Now coming to the miscellaneous funds, see, other than all these type of funds, there are different types of funds available. For example, fund of funds. Fund of fund means these funds invest in other funds, and those funds can be debt oriented funds or equity oriented funds. It is very simple. There is no rocket science in this. It does not hold securities in its what does it mean? It will not buy individual stocks. What does it do? It buy directly the mutual fund which have invested in either equity or in mutual fund. Here, whatever may be the investment objective, you want to have high return, high risk, or conservative. So the 95% of the investment allocation should be in these type of funds. Now coming to exchange traded funds. Exchange traded fund holds a portfolio of securities which replicates an index. For example, it should replicate Nifty 50 index. Okay, and 95% of the assets should be invested in securities which are part of that particular index. Suppose if Nifty 50 is there, whatever is the stocks in the Nifty 50, they have to invest in these type of stocks. Um, the expense ratio of these type of funds will be similar to a index fund. And finally, the settlement is like a stock trade. The ETF prices are always real-time prices. I have already explained this. Now coming to the gold ETF. See, gold ETF invests in gold. Here the gold should have a purity of 99.5% and each unit of the ETS is equal to 1 gram of gold. Hence, for every unit of ETF sold, there should be 1 gram of physical gold which should be held by the fund manager. The gold ETF is also allowed to invest gold deposit schemes up to 20% of the total asset. The return of the gold ETFs are generally less than the market returns due to the management charges they charge you. Now let us compare gold ETF with physical gold. The impurity risk in physical gold is there, but in gold ETF it will not be there. Whereas in physical gold, the liquidity risk will be low because you can sell the gold anytime you want. Whereas in gold ETF, you have to hold the ETF, hence the liquidity risk will be high. The transaction risk will be high in physical gold because when you go and try to sell the physical gold, they, depending upon the purity, they will cut some percentage in the market price of the gold. Whereas in case of gold ETFs, it is not the case. The short-term and long-term capital gain application is same to physical gold as well as the gold ETF. If it is held less than 36 months, there will be short-term capital gain for both physical gold and gold ETF. And long-term capital gain is if you hold it for more than 36 months, you will have a long-term capital gain. Now coming to the real estate mutual fund. See, these mutual fund invest basically in physical real estate and real estate stocks. At least 35% of the total asset should be invested in the physical real estate. These are generally closed-ended funds and they have to be listed on the stock exchange. Now coming to infrastructure debt funds. Um, See, they can be set up either by an existing mutual fund or the new one. What they do is they invest in debt securities and securitize debt of infrastructure companies. You know, there are various national, highway authority of India generally gives bonds. So that is an infrastructure bond. Okay, government comes with an infrastructure bond. Individual infrastructure company can issue bonds. So they invest in basically debt securities of these infrastructure companies. Here, at least 90% of the portfolio should be invested in specified securities, and the remaining can be invested in equity. Now, one more important concept is here is the minimum investment is rupees 1 crore. So, one unit is of a face value of about 10 lakh. Now, coming to it is a close-ended fund and should be listed in the stock exchange. So, what are the options for investing in mutual fund? Now, let us understand what are the factors that affect mutual fund investment. The first and the foremost is the tax and return implication on the return depends on the choice made by the investor in selecting the investment option. What does it mean? Suppose if the mutual fund offers two types of investment option. The first one is you know income distribution come capital withdrawal option. You can withdraw the capital come the income which the fund has earned over a period of time. Here the NAV of the fund will fall, as we have discussed, equal to the dividend which has been paid to the investor. And second option is dividend reinvestment. See, whatever dividend or income which you get out of a particular fund, if you reinvest the same amount, then it is called as dividend reinvestment option. But these two will have tax implication, because every year, if you are within 1 year, you take the capital and the income, whether quarterly or half yearly, it will come into short-term capital gain. Whereas if you reinvest the dividend, the dividend reinvestment will be tax free. So this will have tax implications. Now coming to the triggers of the mutual funds. So what are the trigger types of triggers you can have? Triggering means how do you redeem your mutual fund automatically. So what it does, it helps the investor to achieve the target without having to track the uh, you know uh, market continuously. So, suppose the first trigger can be after you achieve a specified return over your investment, you can redeem it. So you can apply this trigger, and it can be a percentage of your it can be a value. Percentage can be, if I invested 100 rupees, as soon as I get 10% over my investment, I will I will trigger it. So and you redeem the mutual fund. And secondly, it can be NAV based trigger. If you have purchased this at an NAV of 10 rupees, and if you say after the NAV become 20 rupees, I am going to um, redeem, then you can put it NAV based trigger. The next is specified date trigger. Suppose if you want your money after 1 year, so you will invest today, and you say let the mutual fund trigger after 1 year redemption. So the redemption will trigger after the date which you have specified. Index level trigger means, suppose you have purchased a mutual fund when the index and you follow some technical analysis, and you know the market is in an uptrend, and you have purchased it at an index level of 20,000. So you may say that, okay, after the index reaches 25,000, I am going to redeem my mutual funds. So that is called as index level trigger. Now coming to what are the steps in the investment process. For the fresh purchase of mutual fund units, you can do an additional purchase of mutual fund units also. And then the third step will be redemption from a mutual fund. For all these, there will be an application which will be given to you. You have to fill your name, whoever you have to give Aadhaar card, PAN card details, your phone details, your email details, and nominee details. So all these things has to be given, whether you are doing a fresh purchase or additional purchase. But sometimes in additional purchase, if you have got a specific account, so you based on that you can also do additional purchase of mutual fund. Whenever you redeem from a mutual fund, it is quite automatic, as we have explained. Now coming to switch, uh, there are various type of switch you can do. Switch means you can switch from one mutual fund scheme to another mutual fund scheme, and or else from one mutual fund in a same mutual fund scheme, you know you can go from one option to another option. These are all the steps in the investment process. Next, coming to the systematic transaction, there are various systematic transactions which are available. You know, we all know systematic investment plan means you invest every month or every quarter or every half year, and that investment will go into your mutual fund, and they buy whatever is the NAV at that particular date, they buy it. So that is known as systematic investment plan. The systematic investment plan can be done through electronic money transfer or through checks, whatever is feasible. Today, most of these thing is done through electronic money transfer. Now coming to systematic withdrawal plan. So whenever you have invested a particular amount, you may want regular income from that fund. So you may say that I want to withdraw every year a certain portion of my mutual fund. So that is known as the systematic withdrawal plan. You may do the systematic withdrawal for reinvestment also. In that case, it is known as the systematic transfer plan. So in systematic transfer plan, what you do is the whatever money withdraw, you are going to transfer it to some other mutual fund schemes. And finally, DTP. Now we have to DTP is nothing but dividend transfer plan, where whatever the dividend you get, you can transfer it. Now coming to the investment mode. See, there are two types of investment mode. One is known as the regular mode. Regular mode is you now go through a broker and you do the investment. That is known as the regular mode. Whereas in direct mode, you deal directly with the mutual fund company and buy the products directly from the company. That is known as direct mode. However, the portfolio, whatever mutual fund scheme you buy, whether from the regular mode or from the direct mode, the portfolio appreciation or depreciation will remain the same. However, the net income or net profit or loss which you are going to make depends upon the broker. In case of regular mode, will charge certain fees. That fees will not be charged in the direct mode, so you are going to lose out on that broker fees in case of regular mode. But in case of direct mode, you don't have to pay that fees. So these are the various steps in the investment process. uh, so generally, I have tried to make a detailed explanation of various types of mutual funds available, so that based on this concept, you can generally uh, make a very good investment decision in buying the correct type of mutual fund which you want to invest and get capital appreciation. Thank you very much.